Hello, everyone, and welcome back to the latest episode of Real Take Real Estate with the Joseph team, where we give you our real take on today's housing market and everything to do with real estate. I'm your host, Maddie Maloney, joined by my co-hosts,
Joe Sambear
and Sam Feda.
Today, we are going to be talking about debt. Good debt, bad debt, how it has any effect on your credit score, and how it affects your qualification for a new home. Debt is something that we are always talking about with our clients because that is one of the main factors that we're looking at when it comes to your qualification. We look at something called the DTI, your debt to income ratio, and how some of the debt that you have, maybe it's good and you can have it there, but what we really want to see is, talking about what bad debt is and maybe how we can look at eliminating that and increasing your buying power for the next home. So, Sam, wanted to start with you.
Sure.
Can you tell us a little bit about what good debt is?
I think the one that comes up first is essentially a mortgage, because a lot of people don't have, $500,000 in cash to buy a home, and everyone needs a roof over their head. So that for one instance can help you, have your place of solitude where you feel comfortable, where you love being home with your family and all of that. So that is kind of a good source of debt, I would say, to be able to provide for your family. And that kind of also helps to grow your wealth over time in a sense too, because year over year, history proves that real estate is a good investment. Values go up year over year. So if you plan to hold that asset for, 20, 30, 40 years in your family, that can be a good form of debt because it allows you to have that, place of comfort where you live with your family.
Absolutely. And so good debt is something that is going to help you build wealth and increase your net worth over time. It's not going to be something that should be limiting you, but should really help you to live the life that you want to live. Now, when we talk about good debt versus bad debt, obviously we're not following Dave Ramsey's advice, because he would be saying that no debt is good debt at all. But, of course, as long as you can use this debt and not go crazy with it, there's some great opportunities with being able to have home mortgage and some other good areas of good debt. And so a mortgage on a home is only considered good debt if it doesn't stress you out financially. So that's why we've always talked about, in our podcast, we're constantly saying, get a pre-approved early so that you can see what your monthly payment, what the funds for closing, because it should be good debt where it's not, breaking the bank, where you're barely affording your mortgage payment. If it's stressing out your finances, maybe it's not good debt at that point. So there's just a couple of things to analyze when it comes to that.
And all mortgages aren't the same. The terms are different. If you're in an ARM and you can't afford a fully amortized, if there's a rate increase on the ARM and you can't afford that, that's not good debt.
No,
You know what I mean?
Yeah.
So there's we're talking typically when we say good debt on a mortgage would be something you've analyzed, you can afford in the short term and long term.
Fixed rate where the payment's not going to change.
Yes. And an ARM might be advisable in certain situations, but the key on that is, can you make the payment when there is an adjustment, and has that been evaluated?
Exactly. Looking at the longer term plan of, planning for worst case scenario, if that payment does adjust to the max when that term is up, is that something you're comfortable with? Is that going to fit your cash flows to where you're comfortable still living and doing the things you like to do? That all has to be taken into consideration.
Same thing with a home equity line of credit. That's based on prime plus a factor. Are you prepared when it goes up? Are you prepared to make more than interest-only payments and actually pay this off? And do you have a plan for that?
So that was good debt. Joe, can you go into a little bit about what bad debt may look like?
I feel like the list is much longer.
The list
on
is
my side.
much longer on the bad side.
Obviously, any kind of predatory loans are the first ones, which we really hate to see that, like your payday loans or cash advance. Those can be those put you in a really bad position.
It's stuck in a cycle.
Because there is no flexibility. There's no plan. So obviously that's bad debt. Debt used to purchase things that lose value. I mean, the most common example is an auto loan. Like if you get an 86-month auto loan.
Or 96 months.
Or 96 months. Yeah. And there's nothing wrong with, there's actually nothing wrong with the term of that. It's more the matching of what you owe to what the value is of that. I mean, even if it's a 3-year auto loan, it might not be the best. The issue is, are you going to be in a good position throughout that loan where if you needed to sell it or make a change, you're not completely underwater? That's the bigger issue, I think, with the autos and or any kind of loan that has an asset associated. Are you in a good position on equity on that?
Exactly. And that's, purchasing something that's instantly going to drop in value, but you're still paying on it. That can definitely be a tough spot, and that could hinder your overall cash flows too. Because it's like, oh yeah, I said I was approved for this, auto loan. You overspent, and then that can snowball into, oh my God, I got a bigger car payment than I wanted. I got to put more things on credit cards, and then that can slowly over time, the way it affects your cash flows, you're paying into something and it's hurting you more ways than one.
Credit cards are a good example. Obviously, there's some good debt sometimes when you're using that credit card for your business and it's a function of cash flow. You're using it to travel because it's part of your work situation. You're getting reimbursed. There's a plan. Credit cards can be useful for cash flow, but I think the danger is when you get, you might start with a low interest and all of a sudden as that balance is appreciating, your interest rate adjustments. They're adjusting your rate because of your performance or because of the rate environment in the market. And then all of a sudden you find yourself at 23% and you don't even realize what's happening.
Not getting anywhere,
You're not looking at the statements and you're kind of finding yourself in a bad position. So I think one of the useful tools is maybe paying it off every month, setting auto pay, the feature. So you start from day one, you're starting to pay the balance off every month, not pay interest on that.
Yeah, absolutely.
And watch out for the fees associated with having that card as well. A lot of them charge annual fees. So just as long as you're aware of those things and have good control of those things. Personal loans for luxury items, that's usually not a good idea. It kind of goes back to the auto. With boats, we see that too, where all of a sudden you're out of whack with the value. Doesn't reflect where the loan amount is. Boats is a common example, I think.
And you can get really long terms on boat loans too, and that's almost worse than a vehicle, the way those depreciate in value.
Yeah, not that we say you shouldn't do those things, but you just have to understand and definitely the other costs when it comes to that, the maintenance costs, the storage costs.
Absolutely. So it's just like getting your financial goals together, seeing what is the reason behind some of these purchases. Is it actually going to improve your lifestyle? Is it something that, you've been wanting for a while? Maybe you do really want a boat and you've been saving up. That's great. We're not saying that you can't go out and buy a car or have some credit cards. It's just how you use that debt, making sure that you are paying it down as much as you can, not letting that interest accrue, and not going out and maybe buying a brand new vehicle that the moment that you step out of the lot, it has depreciated already. And just knowing, what are your financial goals for the future, and are these purchases helping or hindering those goals, those future goals?
Student loans tends to be one of the more complex ones to analyze about good debt versus bad debt because, we're big believers in investing in yourself and putting yourself in the best environment possible to succeed at the highest level. And obviously that, involves student loans a lot of times to put your career path and invest in yourself. But it's, again, how you're using that. Are you using that for tuition and board, or are you using that for your lifestyle? And I think when we've seen things get really out of control, student loans, it wasn't just the room and board. It was you were also living a lifestyle in college or when you're, post education, higher education there, where you're including your lifestyle.
Oh yeah,
and
you get a chunk of cash from the remainder of the loan that didn't go towards tuition and not doing the right things with it because you don't realize you have to pay it back later on in life.
And another reminder right now that, a lot of the student loans that were deferred previously are now pretty much required to be in repayment. So if you don't have a plan for student loans and you have a student loan, you really need to be checking in to see where you are, what your status is. Don't just assume they're deferred. Make sure you're reaching out. Should they be consolidated? Having those discussions right now is really critical.
Absolutely.
Especially with student loans, lots of people don't know that, maybe you don't have to make payments on it, but maybe your student loan plan that you have right now, there's interest still accruing. And so it may not, you don't have to make any payments, but when we go to look at your credit report, and that interest has accrued, it looks like you are maxing and you are going over the limit of these student loans, which will then have a negative impact on your credit and a little bit harder to catch up over time. So it's not that we're saying you have to pay it down very aggressively, but just being very aware of what that payment structure is, what the balance is, and making sure that you're not going over any limits. You just have a full understanding. And it's not something a lot of people right now would just be like, oh, those student loans, they'll take care of it for themselves. Hopefully the government will pay it off. That's not going to be the case, and you cannot plan on that happening. You have to make sure you take the proper steps in advance so that it's not hurting your credit score. If it drops your credit score significantly and you're looking to buy a house, that could cost you hundreds of dollars with a lower credit score if you're not able to get into the best terms now. So that's something that you can definitely talk with your lender about. We can look at your credit report and we can make sure, nothing is maxing out, or maybe there's some student loans that have a much higher balance than the limit that you thought of, but just making sure that you know that and know how to use it. Of course, student loans aren't always going to be bad debt. You're getting higher education, which is amazing, but just making sure that you can still make those payments, and if you can't, maybe setting up a payment plan so that it's not affecting your credit score. A couple other things. So when you're taking some steps for managing debt before buying, we always suggest coming in still getting pre-qualified. So then we can look at your credit report, see if there's anything on there that maybe you didn't know about. When looking at your credit score, there's a couple of things, maybe not closing out some of the credit card lines that you've had open for a while. It sounds counterproductive, like, I don't use this card, why should I keep it open? Well, it actually does help in the long run because it gives you the history of having credit open for a long time. So try not to close any other older credit cards, just making sure you're keeping them paid off. Try not to open any new lines of credit right before or during buying your home. It may affect your qualification then at that point. Of course, maybe it is just something good that happened, but there's always going to be some implications if you're opening up some different lines of credit. And then, of course, like we said before, just talk to your lender early so that we can help you maybe understand some things that you didn't even think about in this process. So that's just a couple of tips for managing debt.
The other thing is, monitor your credit. Get with Credit Karma or one of the credit bureaus.
TransUnion, yeah.
And so you see those alerts like, oh, my score dropped because I'm not utilizing my credit properly, or this happened, or a new account got opened. It is very valuable to monitor your credit and just, peel back the wound a little bit, see what you're dealing with. Let's just look at your credit report. Let's see it can be really difficult, and I understand the apprehension to do that, but to fix this, we need to let's just see what it looks like. Let's actually see your budget, put it on a piece of paper. And then you might have to, you mentioned Dave Ramsey earlier. The one great thing he does have is like an emergency plan when things are out of whack. Yeah. It's a great plan. And there's other ones like that. You might need to find something that's a planned of attack when you get in a bad position. Yeah. So I think those things are kind of important to do and we would be more than happy to have those conversations, give you little tidbits and thoughts of how to kind of attack that.
So now kind of talking a little bit more about how it may affect your qualification for a home. One of the biggest things that we see on people's credit report that has a major impact is going to be that car loan. Now, not saying you can't have a nice car. Of course, we want you to have something that is safe and reliable, but maybe that's not going out and buying the most luxury brand new car possible. So I wanted to give an example of kind of how it will affect your qualification. Let's say that your lease is up, maybe you're looking to buy or lease again, and you have the option between a $400 monthly payment and an $800 monthly payment. Well, maybe the $800 one for this brand new car that you really love is something that you really want. But in the back of your mind, you're also thinking, all right, well, I do want a house as well. And it's kind of setting up those priorities, because if you do go with the higher monthly payment or car payment of $800 a month, every $100 a month in mortgage payments equals to about $15,000 to $20,000 in buying power. So if you go up $400 in your car payment, you're going to be losing close to $70,000 in buying power. And it just sounds crazy, and some people don't realize. You're like, oh, well, it's only $400 extra a month. I should still be qualified for the same amount. Well, when we're looking at that debt to income ratio, it will have a huge impact, and that may prevent you from getting into your dream home. If you're looking at something that was maybe $400,000, but you just got this brand new car with $800 monthly payment, now you're only going to be qualified for maybe $330 or lower. So just making sure you set your priorities straight. If you're thinking about getting a new car, but you also want a home, maybe let's think about getting the home first and then the car afterwards. But just knowing how much it affects your qualification is super important, because it's just one of the things that we always see is just, well, you could have been qualified for this home that you really wanted, but you have this $1,000 car payment, so kind of have to pick and choose at that point.
And even if it doesn't affect your qualification, it's likely going to affect your savings, taking a vacation, setting up a college fund, putting into retirement, having flexibility. So even if it doesn't stop that, it's usually putting you in a tougher position.
All right, so that was good debt versus bad debt. You know, there are ways to utilize some of this good debt. Home mortgage can be good debt. You know, it is some of the cheapest money people say that you can get with a home loan. It's going to have the lower interest rates versus if you're looking at something else, but it can be great and you can use it to your advantage. And so that's why we just wanted to kind of talk about the different implications of some of the debt that you have. If you have any questions, or maybe if you're in the process of looking for a home and your car just failed or crashed out and you're looking to get a new one, talk with your lender to see, all right, I'm looking at getting this new car payment. How much is this going to affect me? What should I really be looking for if my main priority is getting into a home and being a homeowner? So, of course, we will help guide you through it. We'll help you review your credit report, maybe come up with a plan of maybe some debts that we can pay off before looking at purchasing. But there's lots of options available, and please do not hesitate to reach out to your lender, reach out to your financial planner, and see how you can tackle your debt to become qualified and get into the home that you want to. So thank you so much, everyone, for joining our episode today on Real Take Real Estate with the Joseph team. We hope to see you next time. If you like today's episode, please like, comment, subscribe. We would love to hear your feedback. Thank you so much.